Welcome to the Deep Dive. We're the place that takes complex stuff, boils it down, and gives you what you really need to know.
Yeah, shortcutting that learning curve.
Exactly. And today, we're tackling something pretty big for small business owners. The S-Corporation tax election. You hear about it a lot. Saves money, right?
Yeah.
But it's got some serious rules attached.
Oh, absolutely. It can be a fantastic tool, but you mess up the rules and it can bite back hard. So our mission today is pretty clear.
Right.
We're going past the hype. We need to look at the real tax savings, sure, but also the administrative load, what you have to do, and those crucial deadlines for filing the paperwork, Form 2553.
Yeah, the paperwork. So this is really for you, the listener. Maybe you've got an LLC or a C-Corp, and you're wondering, should I do this? And crucially, how do you avoid those, expensive mistakes?
That's the core question, isn't it? Is all that extra admin work, the complexity, maybe even the audit risk, is it actually worth the tax savings you might get? And what are the compliance spots you really need to watch?
Okay, let's dive in then. Let's start with the big why. What's the number one reason people make this switch?
It's almost always about one thing: avoiding self-employment tax.
Okay, so let's clarify. It doesn't lower your regular income tax rate.
No, not directly. Your profit is still taxed at your personal income tax rate, but the S-Corp structure lets you avoid paying self-employment tax on part of that profit. And that SE tax, well, it's pretty hefty.
How hefty are we talking?
Right now, it's 15.3%.
Wow, 15.3.
Yeah. And if you're just a standard LLC taxed like a sole proprietor or a partnership, that 15.3% hits all of your net business income, 100% of it.
Ouch. Okay, break down that 15.3%. What does it cover?
So you've got 12.4% for Social Security, but that's only up to a certain income level each year, the wage cap. Then there's another 2.9% for Medicare, and that applies to all your earned income. No cap on that part.
Got it. So in a default LLC, every dollar of profit gets hit with that full 15.3% before you even think about federal or state income tax.
Precisely. That's the baseline.
Okay, so how does the S-Corp change that calculation? You said it avoids some of it.
Right. The S-Corp structure forces you, the owner, to split your compensation. Part of it must be paid as formal W-2 wages, like a regular employee.
Okay, W-2 wages.
And that wage portion. It is subject to the full 15.3% employment taxes, Social Security, and Medicare, just like any job. But then any remaining profit after paying that wage can be taken out as a distribution.
Ah, distributions. And the key is?
The key is those distributions are not subject to the 15.3% self-employment tax. That's the loophole, essentially.
Okay, let's make that concrete. Use that $100,000 income example.
Perfect. So imagine your business nets $100,000. Default LLC, like we said. 15.3% on the whole $100 K, that's $15,300 in SE tax. Simple but costly.
Right. Now flip it. Same $100,000 net income, but you're an S-Corp.
Okay, now you have to pay yourself a wage first. Let's say you determine a reasonable wage for your work is $35,000.
Reasonable. We'll come back to that word.
We definitely will. So $35,000 in W-2 wages. The SE tax, or rather employment tax, since it's W-2, is paid only on that $35,000.
Okay.
The remaining profit, $65,000, can be taken as a distribution. And that $65,000, zero self-employment tax on it.
So the saving is 15.3% of that $65,000 distribution.
Exactly. Which comes out to, let me see, about $9,945 saved. Just on SE tax. You still owe regular income tax on the full $100, but you've avoided nearly $10,000 in SE tax.
That's significant savings. That's the aha moment right there.
That's the driver, absolutely.
Are there other quick wins, like, say, if you were previously a C-Corp?
Yeah, a couple of big ones. If you're converting from a C-Corp, you immediately ditch the double taxation issue, where the C-Corp pays tax at the corporate level, currently 21%, and then shareholders pay tax again on dividends. S-Corp avoid that entity level tax.
That's true, right.
Pass through, exactly. And then there's the QBI deduction, qualified business income. S-Corp owners can potentially deduct up to 20% of their business income. Big asterisk here, though. That QBI deduction is set to expire after 2025 unless Congress acts. So keep an eye on that one.
Okay, the savings are clear, potentially huge. But, here comes the but, right? The compliance part. You mentioned that word, reasonable salary. This sounds subjective.
It is subjective, and that's precisely where the danger lies. This is, without a doubt, the #1 audit trigger for S-Corp. The IRS is very interested in this.
So you can't just pay yourself, $10,000 a year and take the rest as distributions if your business is netting six figures.
Absolutely not. Well, you can, but you're basically painting a target on your back for an audit. The rule is your W-2 wage needs to reflect the actual value of the services you perform for the company. Think about what it would cost to hire someone else to do your job. Your education, your skills, your industry, your location, it all factors in.
And if the IRS audits you and decides your salary was unreasonably low, what's the damage?
It's bad. Really bad. They'll look at your distributions, reclassify a chunk of them as wages that should have been paid, and then hit you with back employment taxes, penalties, and interest on that amount.
Oof. Penalties and interest could double the tax, can't they?
Easily. It can wipe out years of the savings you thought you were getting. Plus, you're paying accountants or lawyers to defend you during the audit. It gets expensive fast.
Okay, so reasonable salary isn't just a suggestion, it's a critical compliance point. What else adds to the administrative burden? You mentioned payroll.
Right. Once you're an S-Corp owner employee, you have to run formal payroll. You can't just transfer money anymore.
So that means setting up a payroll system,
Mm-hmm.
withholding taxes, filing quarterly reports.
Yep. Federal and state withholdings, unemployment taxes, quarterly Form 941s, annual W-2s and W-3s. It's a whole new layer of administration compared to a simple LLC draw.
That sounds like it could significantly increase, say, your accounting fees too.
It often does. You need a separate business tax return, the Form 1120S, which is generally more complex than Schedule C for a sole prop. Plus, managing payroll compliance adds time and cost.
And you mentioned something earlier, tax basis. Why is that such a big deal?
Ah, yes. Tax basis. This is another hidden trap, and it's crucial. Think of your basis as like your running tally of what you've invested and the company money you put in, plus profits left in the business, minus distributions you've taken out.
Okay, so it tracks your actual investment. Why is it a disaster if you lose track?
Because distributions are only tax-free up to your basis amount. If you take distributions beyond your calculated basis, those distributions suddenly become taxable income, usually as capital gains.
Oh, wow.
And here's the kicker. Basis is cumulative. It builds year over year. If you switch accountants and they don't get your prior basis calculation right, or if you just haven't tracked it properly, the IRS might assume your basis is zero.
And then all your distributions could potentially be taxable.
Potentially, yes. Or losses you try to claim could be disallowed. It completely undermines the benefit. Tracking basis meticulously is non-negotiable. It turns what seems simple into something needing real diligence.
Okay, this is definitely getting complex. We're talking subjective salary rules,
Yeah.
mandatory payroll, extra tax filings, tracking this cumulative basis thing. The stakes feel pretty high if you get it wrong. You need someone who really knows these specific IRS rules, right?
Absolutely. You can't just wing it. From figuring out that defensible, reasonable salary to keeping perfect track of basis year after year, you really need personalized attention and someone watching your back all year round, not just at tax time.
This sounds exactly like where having the right tax partner becomes critical. Which brings us to RDPC Tax Group. They aren't just form fillers. They're well-trained tax preparers focused specifically on following IRS and state guidelines to the letter.
Which is exactly what you need with an S-Corp. That focus on compliance, the year-round support they offer that's essential for managing this kind of complexity and actually keeping those tax savings without tripping into penalties.
Right. They provide that personalized care that something like calculating reasonable comp or tracking basis really demands. So if this deep dive is making you question your current setup, or maybe you're thinking about the election but worried about the compliance,
Don't guess. Getting it wrong is too expensive. Having a dedicated team that understands S-Corp specifics, handles the payroll integration, tracks that basis, that's how you make this work properly.
definitely. So take that next step. If you want clarity on this for your business, book a discovery call with RDPC Tax Group. Use the link right below this deep dive. Get your questions answered by pros who live and breathe this stuff.
Good advice. Okay, so we've talked about the benefits and the burdens. But who shouldn't do this? When does the S-Corp election just not make sense?
Good point. It's not for everyone.
Yeah.
Who should probably wait or avoid it entirely.
Well, first off, businesses that aren't making much profit yet, or maybe startups. If your net income is pretty low, say $20,000 or $30,000, and a reasonable salary for your work would also be around $30,000.
Then there's nothing left for distributions.
Exactly. You pay yourself the required reasonable salary, and there's zero profit left to distribute. So you've gained zero SE tax savings, but you've taken on all the cost and hassle of payroll and the 1120S return. You're actually worse off.
So wait until your profits are comfortably above what your reasonable salary would be.
Definitely.
Yeah.
You need that spread between reasonable salary and total profit to make the distributions worthwhile.
What about the other end? Really high earners. Does it lose its appeal?
It can, yeah. Remember the Social Security part of SE tax caps out? Currently, it's around, what, $168,600 for 2024? If your reasonable salary is already at or above that Social Security wage base.
Then you're already maxed out on the biggest chunk of the SE tax anyway, just from your salary.
Right. Any distributions you take are only saving you the 2.9% Medicare portion of the tax. Now, 2.9% isn't nothing, but when you weigh it against the administrative costs of the payroll service, the extra accounting fees for some high earners, the net savings might become pretty minimal. Maybe not worth the complexity.
Okay, that makes sense. And there are also strict rules about who can even be an S-Corp owner, right? Structural limitations.
Yes, absolutely mandatory rules here. First, you're limited to 100 shareholders or members, so not for massive companies aiming for public offerings.
And the owners themselves.
Critically, all shareholders must be U.S. residents. No non-resident aliens allowed as direct owners. This trips people up sometimes.
What about other companies owning the S-Corp? Can my LLC own my S-Corp?
Generally, no. You can't have corporations or partnerships as shareholders. There are a few exceptions, like a single-member LLC that's disregarded for tax purposes can own S-Corp stock and certain types of trusts. But the general rule is individuals or specific allowed entities only.
And one other big one, stock types.
Crucial point. An S-Corp can only have one class of stock or membership interest. Meaning all shares must have identical rights to distributions and liquidation proceeds. You can't have, say, Class A shares with preferred dividends and Class B common shares. Everyone has to be treated proportionally based on ownership percentage. If you need complex equity structures, the S-Corp isn't going to work.
Gotcha. And you mentioned real estate earlier. Generally not a fit.
Yeah, generally S-Corp status isn't ideal for businesses whose primary activity is holding rental properties. Passive rental income usually doesn't benefit from the SC tax saving structure anyway, so you'd be adding complexity for likely no real gain. Stick with an LLC taxed as a partnership or sole prop usually.
Okay, so lots of filters there. But if you clear those hurdles and decide, yes, S-Corp is for me, then the timing becomes critical. Filing that Form 2553.
Non-negotiable deadlines. You cannot mess these up.
Okay, lay them out. New business first.
If you just formed your LLC or corporation, you have a very tight window. 2 months and 15 days from the day of formation.
2 months and 15 days. That's really fast.
It is. So if you form your company on, say, January 7th, you need to file Form 2553 by March 21st. You need to decide and act almost immediately.
Wow. Okay, what if I have an existing business, an LLC maybe, that's been running for a while, and I decide I want to switch to S-Corp status for this year?
If you missed that initial window when you first formed, you get another chance each year. But again, it's a hard deadline. To make the election effective for the current calendar tax year, you must file Form 2553 by March 15th.
March 15th. Okay, so that's basically 2 months and 15 days after the start of the tax year, Jan 1st.
Exactly. Miss that March 15th deadline, and your S-Corp election won't take effect until the following tax year. You lose out on the savings for the entire current year.
Now, I've heard there's sometimes late relief possible. Like if you miss the deadline.
There is, but you really don't want to rely on it. You have to file for late election relief and demonstrate reasonable cause for missing the deadline and meet all the other eligibility rules. It involves extra paperwork, uncertainty, and you're basically asking the IRS for permission.
Not a position you want to be in.
Definitely not. It just underscores why planning ahead and getting expert guidance, maybe from a group like RDPC, is so important to hit these deadlines cleanly from the start.
Okay, let's wrap this up. We've hit the big points. Yeah. Huge potential savings on that 15.3% SE tax for distributions. That's the carrot.
Right.
But the stick is the compliance burden. Mandatory payroll, potentially higher admin costs, and the absolute necessity of setting a defensible, reasonable salary and tracking that tax basis like a hawk.
Yeah, knowledge is one thing, but applying it correctly is everything here. These rules, they seem complex, but understanding that fundamental difference between wages and distributions and knowing where your risks are, like basis tracking, that's key to actually saving the tax and staying out of trouble with the IRS.
So final reminder, don't try to navigate these very specific, very strict IRS rules on your own. Especially things like the reasonable salary. That's a judgment call you want expert backup on. Whether you're just thinking about the S-Corp election or you've been operating as one for years, make sure your compliance is airtight.
Get professional eyes on it.
Absolutely. Book that discovery call with RDPC Tax Group. The link is right there below. Get that peace of mind.
Okay, and before we go, here's that final thought for you, the listener, to chew on. If you successfully use the S-Corp structure to save thousands in SE tax by taking significant distributions, think about this. What does paying yourself that required W-2 salary enable you to do? Specifically, what powerful tax-advantaged retirement plans, like maybe a solo 401k, does having W-2 wages open the door to setting up within your business?
Good one. So the W-2 wage isn't just a hurdle, it can be a key to other financial strategies too.
Exactly. The savings are just the start. The planning opportunities can be even bigger.